how much you started with. Maybe this is a good chance to talk about the cost or the fees, because typically a lot of times people will get the premium and the cost mixed up. And that's because typically if you have any type of insurance, the premium, like car insurance, right? Your premium is just what it costs, right? If you're paying $200 a month for car insurance, that is pure cost. Right? Most life insurance policies, especially if it's term, if you're paying $20 a month, $50 a month, whatever the number is, that's the premium, then that's usually pure cost. Anthony is actually technically paying well above what the insurance costs, like on purpose.
Yeah, so based on this specific contract in 2021, I was comfortable with saving $800 a month into the policy, but I already knew that I wanted to overfund the policy to the maximum and leverage the funds out. We built the policy to hold, well, as like the comfortable savings amount, $800, and everything excess of that money is going to be, let's call it equity. So I didn't really have to take out loans the first month. I had access to it, but I was just more of trying to build this asset as quick as I can.
Yeah, the interest rate is 5%. That is a current interest rate. Policy loan interest rates aren't directly tied to your home mortgage rates and car rates. Typically, it's going to be lower than what you'll get out in the market, usually. Okay. And that's what we're today.
I'm going to share this. Yep. So this is going to be pretty much a timestamp of transactional things that happen throughout this policy. Like I said, we built the policy to only take $800 is going to be like the minimum savings amount or my comfortable savings amount. But you can see I was pretty consistent with $3,000 going in. I wanted to build this as quickly as possible, and I didn't really need the funds out like an emergency. I actually had most of this already saved in a savings account. My cue for you guys, make sure that you guys have at least 3 to 6 months in a savings emergency fund. You always want to make sure you have something liquid, even outside of an IUL, because IUL still take time to take loans from the policy. That's just my disclaimer. So $3,000 is going in, and this started 12/30/2020, and I was putting in $3,000, and you can see I took my first loan in June of $3,000, and pretty much regularly I've been putting in overfunding it on purpose so then that I always have additional cash to leverage out. I don't want to bore you guys with just simple numbers over here, but you can see I took out money within the first year, plenty of it. This is all 2021, and I even say I took out a big one. Yeah, so I even took out 21,000. I also put in 21,000, but simply put, the fees were based on the comfortable savings of $800 a month. Everything excess, which you can see I haven't put in $800 from like the start of this thing. It's been way more funds than that. It's just going in as equity to utilize.
Yeah. So just to recap, so basically you've been putting in at least 3,000, like just whenever, not like sometimes you put it in every month, sometimes it's more, sometimes it's less, sometimes you skip months. Could you go back to the other page where it showed your death benefit real quick? Because I still think some people might be looking at that saying, wait, you're paying $3,000. Like a lot of people don't really wrap their head around it until they actually see the fixed cost. So Anthony is paying $3,000, but it doesn't cost $3,000. Say that one more time. He's paying $3,000, but the insurance doesn't cost $3,000. So what does the insurance cost? Let's see.
All right. So the insurance only costs $61, and this is going to be a monthly figure. These are also going to be fees associated on like a monthly basis. Is going to be the expense charge, $189, and then there is a surrender charge. For those that don't know what the surrender charge is, basically a hold on whatever amount is shown right there. In this case, 303. And that's basically just a hold. It's going to be on a 10-year schedule. So it started off, I want to say it was closer to 700 or 800. And this is 4 years ago. And then every year it's going lower and lower until that 11th year, it'll actually be zero. And there won't be any more money that they're holding. And that's just for the insurance companies to recapture some of the money that they had to lock away in storing partially this $1.3 million of death benefit, because if I was to pass away, they would have to pay that out pretty urgently when they want to keep majority of their funds in longer term investments. So they do have to liquidate some of their funds that are currently being invested. When people get a contract enforced, they have to put it into more liquid assets or cash equivalents. So
and I just drew some lines up there, some words just to illustrate that, just in case you guys didn't catch it. So remember, Anthony's paying $3,000 a month, but the insurance doesn't cost $3,000 a month. The insurance costs $250 a month for the $1.5 million death benefit. So if he pays $3,000 and the insurance company takes out $250, then there's a bunch of cash value that's left over. That's what he can use. That's essentially what is in the index account, and that's what can compound and earn uninterrupted interest for the foreseeable future.
the difference between the account value that you see up here and the net cash value, the large difference between those two numbers, I'm actually utilizing the funds to pay for expenses, building other assets, my whole lifestyle. I'm running those funds through this policy as much as I can, and then leveraging the funds out via a loan to fund my lifestyle. But by putting the money here first, you can see I'm capturing a large value that is going to be in my account, making interest returns based on the S&P 500. The interest on average is going to be 7% that the S&P returns, compared to a loan roughly 4 to 5%. We always just assume 5, the higher number on average. And just by looking at those two numbers, if I'm making 7% and then it costs me 5% to loan that money out, it's still an arbitrage or a difference of 2% that I'm making on borrowed money.
Exactly. And somebody said the more you invest, the more you can loan out. Essentially, yes. Because we're not even accounting for the interest earned yet, right? Typically in the earlier years of your insurance policy, you're paying more cost up front than what you're getting back. But the longer you have the policy, the cheaper the policy gets, and then the more compounding interest takes effect, and you're actually able to pull out more money than what you actually contributed into it. But it does take some time, right? This isn't a get rich quick type of asset that you would acquire. It's for the long term. It's a place where you can save cash and you can leverage cash and use it to acquire other assets or just fund your day-to-day lifestyle. And also the legacy play, right? The legacy play.
Definitely the legacy play. And I feel like a part of this that's real slept on, that we don't touch on, is going to be the living benefits. If I was to become sick, because most of the time, especially the way here in America, at least, we consume our foods, a lot of people do become ill prior to dying. And sometimes dying is not like the worst result. It might just be living and having a series of illnesses that are just lifelong from there. Now you have, number one, a limit on how you can live, but also number two, a financial burden that you have to now incur. If you don't have insurance, it's straight out of pocket or draining other assets. But if you do have something like this in place, you can actually utilize a portion of this death benefit, this 1.3 over here, to help subsidize the financial burden of, let's say, becoming ill, whether that be like a heart attack, stroke, terminally ill. That's a common one that we don't really touch on, but it's definitely one of the reasons why I got this policy.
So somebody said